PDI Americas editor Andrew Headland met with industry luminary Howard Marks of Oaktree Capital at the PDI New York Forum. The two of them discussed how an industry downturn may leave some managers exposed. Nonetheless, Marks is of the opinion that the industry still has plenty of room for growth.
We have Howard Marks of Oaktree Capital with us. Thank you so much for joining us. Got just a couple questions about the private credit asset class. The first is, what do you see as the market size for private debt? And is it nearing its capacity, or do we still have a lot of room to grow?
I don't really have a number for the size. Whether it's at capacity, look, I think that if you offer companies money with low interest rates and structures that don't constrict them, they'll take it. So from the supply of debt side, I think there's a way to go. At the same time, I think that investors need the returns that private debt can provide, and so I think that they will still be taking it up. So, if those two assumptions are right, then I think that the size of the market can grow further.
You mentioned investors needing the returns that private debt can offer. Do you think a lot of the U.S. investors, that geography specifically, do you think a lot of the U.S. investors have come into the asset class, or do you think there's still more to be had?
I would imagine that most institutional investors already have some allocation to private debt. They may expand it in the future, but I think that the asset class has been in existence and expanding strongly for 8 or 9 years now, and so I would be surprised if there's anybody out there who hasn't heard of it and made some investment.
And what are the biggest obstacles that the asset class faces in the years ahead, and how do you think it'll overcome those?
Well, one of these days, believe it or not, we're going to have a recession. And, defaults on high-yield bonds have been running below average for almost 10 years now. One of these days, we're going to have a pickup in bond defaults, and that will impact the private debt market as well. And so, number one, given how long it's been since we had a spate of defaults, that may come as a shock to people. Shocks have the effect of lowering asset prices. Number one. Number two, at that point, there'll have to be a large number of restructurings. So then the restructuring community will get busy, and the debt investors will have to participate in the process. And then third, on some of the debt, the recoveries will not be very high. And those will be the cases where the lender made a bad decision, took too much risk of principal loss in exchange for too little coupon. And, Warren Buffett always puts it best, and back around early '09, he said, it's only when the tide goes out that we find out who's been swimming naked. It's only in tough times that we find out who's been making bad investment decisions. And we've had good times for 10 years. So there hasn't been any testing. Bottom line is there will be testing.
Obviously, some of the testing might come along as a result of the very loose terms and covenants and whatnot in today's deals. Do you think the covenant-light deals of today are tomorrow's distressed opportunities?
Well, the lack of covenants will not make them distressed. What the lack of covenants does is that it obviates technical defaults and pushes defaults off until later. If you don't have covenants, then you can only have a money default. So if the next time the credit market slams shut, as opposed to being wide open as it is today, if at that point in time your company needs money to service its debt, maybe to roll it over, and it's not available, then that's when the testing will come. But right now the covenants are reducing the number of defaults, pushing them out into the future. If the future that they've been pushed to coincides with a credit crunch, then we'll see more defaults, and maybe because they've been pushed off so long for money-losing companies, the defaults will be worse, the recoveries will be worse than they otherwise would have been.
We've been in, as you said, good times for a decade or so now, and that means a lot of the people who have entered private credit on the manager side have only lent in good times. So does a track record during good times, is that indicative of how you might perform in bad times?
No, absolutely not. Absolutely not. One of the things that I say in my book, Mastering the Market Cycle, is that there are three ingredients in success: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need that much skill. Well, the last 11 years have been the right time for aggressiveness. So if you applied aggressiveness in the last 11 years, you probably have a superior investment record today. But if you applied aggressiveness and didn't have skill, you'll look bad today, but it's not going to help you when we run into a time of testing.
Thank you so much, Howard. Pleasure to have you join us this morning.
Great to be here, Andrew. Thank you.